Let me ask you something. What if your life wasn't just, a story or a series of experiences, but a financial balance sheet, one that you have to actively manage? It sounds kind of out there, I know. But in the world we live in today, this isn't just a thought experiment. It's becoming our reality. So let's just put it out there. Are you a person or are you a portfolio? It's a heavy question for sure, but it gets right to the heart of what's happening. The line between who we are and what we're worth financially is blurring like crazy, and you absolutely have to understand this shift if you want to navigate the modern world. So let's introduce the core concept here. Welcome to Me Incorporated. Yep, that's you. In this new paradigm, you're recast as your own little company. You are the CEO, you're the main asset, and you're the product, all rolled into one. And you are totally responsible for your own profit and loss. Suddenly, all those big life events, your education, getting sick, planning for retirement, they're not just life events anymore. They're financial events. And here's what that looks like. It's your own personal balance sheet. On one side, you've got your assets, and that's not just cash in the bank, right? It's your skills, your health, your social network, all the things that can generate income for you in the future. And on the other side, well, that's your liabilities. Debt, rent, medical bills, you name it. The whole game is to keep your personal equity in the positive. But here's the kicker. The rules of this game and the amount of risk you're forced to take on change dramatically depending on where you're playing. All right, so let's check out our first game board, the United States. You can think of this version of the game as playing life like a high-leverage hedge fund. The potential rewards, they're massive. But the potential downside, man, one bad move, one unlucky break, and you can get completely wiped out. The fundamental rule of this game is something called the Great Risk Shift. See, it used to be that big institutions, corporations, the government, they absorbed the huge, scary life risks. But now, that's all changed. Those exact same risks, like a sudden illness or a market crash right before you retire, have been taken off their books and shifted directly onto your personal balance sheet. They are your problem now. A perfect and brutal example of this is at-will employment. Now, think about it like this. An old-school job contract was kind of like a financial instrument called a put option. It was basically insurance. It guaranteed you could sell your labor at a certain price, even if the economy went south. Well, in the U.S. model, that insurance policy, it's been stripped away. Now, companies just pass all that market volatility, all that risk, directly on to you. And this, right here, is the crucial difference. When a company is failing, it gets to file for Chapter 11 bankruptcy. It's a reset button. They get to reorganize and try again. But for you, for Me Incorporated, there is no Chapter 11. Insolvency isn't a financial reset. It's a threat to your actual survival. The safety net just isn't there on the same scale. So let's just walk through how this can play out. A serious illness hits. In this system, that's not just a health crisis, it's a financial margin call. And you have to meet that call. So you drain your savings, you raid your 401k. And if that's still not enough, the next step is forced liquidation of your assets, including your home. The data here is it's stark. The US spends almost double what Australia does per person on healthcare, and yet medical debt is the #1 cause of personal bankruptcy in the States. Think about that. In the US, a hospital can put a lien on your house to collect a debt. In Australia, that kind of risk is basically non-existent. Okay, so that was the high-stakes game. Let's switch over to game board number 2. This is the safety net model, what you'd find in places like Australia and much of Europe. And here, the game is completely different. You're not a high-risk hedge fund anymore. Here, you're an insured player. And the key concept is called decommodification. It's a fancy word for a simple, powerful idea that your basic survival shouldn't be something you have to buy on the open market. The state steps in and acts like a giant reinsurance company, pulling all those massive systemic risks across the whole population. So remember that put option, that job insurance that got stripped away in the US model? Well, Australia's Medicare system gives every single citizen a free one for their health. It is a rock-solid guarantee that your maximum financial loss from getting sick is capped at pretty much zero. It completely eliminates that terrifying tail risk of medical bankruptcy. Now, how these safety nets are designed is absolutely critical. In the US, you often run into something called the welfare cliff. Just look at this chart. You work hard, you get a small raise, and that little bit of extra income pushes you over a threshold, and you lose all your benefits. Benefits that were worth way more than the raise. It's insane. Your marginal tax rate is effectively over 100%. You literally end up poorer for earning more money. Australia, on the other hand, uses a smooth taper. As you earn more, your benefits gradually decrease. It just makes sense, right? It incentivizes you to keep working and climbing the ladder. The cliff system? it can literally create a poverty trap, actively punishing people for trying to get ahead. But of course, this insurance isn't free. There is a cost, and that cost is a high tax burden. Australia's top marginal tax rate is 47%. So the system does an amazing job protecting your downside, but it also absolutely caps your upside potential. So let's put these two systems side by side. When you boil it all down, it really comes down to which game you're built to play and what kind of risks you're truly willing to take on.
This slide, right here, this is the whole explainer in a nutshell. In the US model, your human capital, that's you, is treated like a high beta stock, high risk, high potential reward. In the welfare model, it's more like a structured note, where your principal is protected, but your potential gains are limited. And in a pure socialist model, you're like a super safe government bond, almost zero risk, but also very low returns. Each one allocates risk in a fundamentally different way.
So I want you to really think about it. Look at your own life, your career, your personal safety net. Which one of these financial instruments best describes you right now? Okay, so now that we understand the different game boards, we get to the real question. How do you win? Well, for the savvy individual, the differences between these systems aren't just academic. They create some seriously powerful opportunities for strategic advantage. The master strategy is called institutional arbitrage. It's about exploiting the differences between systems. First, there's geo-arbitrage, earning money in a strong currency like US dollars while living somewhere with a low cost of living. Then there's identity and tax arbitrage, using things like digital nomad visas to go jurisdiction shopping for the best tax rates. And finally, if you're in a high-risk country, you use defensive allocation. You build your very own private welfare state with a big pile of cash reserves. And this chart just shows you the incredible power of that strategy. An engineer making $150,000 in San Francisco. After taxes and insane living costs, they might save very little. But that same person earning that same remote salary while living in Lisbon, their savings absolutely explode. Why? Because the liability side of their personal balance sheet just plummeted. Which all leads to what might be the optimal solution, a hybrid approach, a mixed strategy. You leverage the dynamic, high-growth, high-risk markets of one system to earn your capital, and then you leverage the safety, security, and lower costs of another system to protect that capital. And maybe more importantly, to protect your body and your peace of mind. And that leaves us with one final thought to chew on. In this new world of me incorporated, where every single one of us is our own company, you have to decide what your role is. Are you going to be the savvy CEO, making the tough, strategic decisions to make sure your enterprise survives and grows? Or are you just the asset on the balance sheet, waiting for the system to decide when it's time to liquidate?